Hello and welcome to another homework help video. This video continues a series on typical banking problems found in introductory macroeconomics and finance economics courses. This video looks at calculating the change in required reserves of a bank when individuals put more money into a bank that already has deposits. Before looking at a typical problem statement and a way to answer the problem statement, let's review some terms and concepts such as fractional banking, deposit, withdrawal, reserve ratio, and the required reserves. Also, let's take a minute to review the formulas for calculating required reserves and the change in required reserves. One of the keystones of understanding modern banking systems is fractional banking. A fractional banking system is one where banks and other thrift institutions, like savings and loans and credit unions, accept money from the public. They use this money to make loans and collect interest on the loans. However, the government requires banks to keep a portion of the money they accept in case the public wants access to their money. A deposit is the money individuals place in the bank for future use. A withdrawal is money taken out of the bank by an individual. The reserve ratio is the ratio of required reserves to deposit. Problem statements represent the reserve ratio as a decimal, a rational number, or a percentage. If the problem statement represents the reserve ratio as a percentage, divide the percentage rate by 100% to get the decimal rational number. A bank's required reserves are part of its deposits, and the government requires them to be kept on hand to satisfy the customer demand for their funds. If the bank already has reserves, the formula for calculating the required reserves is required reserves equal deposits times reserve ratio. Sometimes a problem statement will ask about finding the change in the amount of reserves held by the bank. The change in required reserve uses the same basic formula with a slight difference in presentation. The formula becomes change in required reserves equal change in deposits times reserve ratio. The scientific community, including economists, uses the Greek letter delta to represent the concept of change. So the words change in may be replaced with a delta in the formula. So replacing change in with the Greek letter delta, the formula is rewritten as delta required reserves equals delta deposits times reserve ratio. If the person deposits money or puts money into a bank, the deposit change is positive. If the person withdraws money or takes money from the bank, the change is a negative change in the bank's deposit. Now, let's look at a problem statement with a reserve ratio given as a decimal number, or rational number. A bank has $5,000 in deposits. Tim deposits $2,000 in the bank. The country's central bank has a reserve ratio of 0.025 of their deposits. How much additional required reserves must the bank hold to satisfy the central bank? Let's look at the strategy to find the change bank's required reserves given a new deposit of funds into bank with existing deposits and a reserve ratio set by the central bank. 1. Write the formula for calculating the required reserves. Change in required reserves equals change in deposits times reserve ratio. 2. From the problem statement, locate the change in deposit amount and substitute it into the formula. 3. From the problem statement, locate the reserve ratio and substitute it into the formula. 4. Multiply the amount of the deposit by the reserve ratio. Now let's apply the strategy to the problem statement. 1. Write the formula for calculating the required reserves. Change in required reserves equals change in deposits times reserve ratio. 2. From the problem statement, locate the change in the deposit amount and substitute it into the formula. In the problem statement, when the bank receives a $2,000 deposit from Tim, its total deposit will change. Since Tim's deposit adds to the bank's deposits, let's substitute a positive $2,000 from the problem statement into the formula for the deposit. 3. From the problem statement, locate the reserve ratio and substitute it into the formula. In the problem statement, the central bank set the reserve ratio to 0.025. So, let's substitute 0.025 from the problem statement into the formula for the reserve ratio. 4. Multiply the amount of the deposit by the reserve ratio. The deposit from the problem statement is $2,000, and the reserve ratio is 0.025. Multiplying the deposit of $2,000 by the reserve ratio of 0.025 is $50. So when Tim deposits $2,000 into a bank and the central bank sets the reserve ratio at 0.025, the bank's required reserves increase by $50. One of the essential pieces of knowledge for understanding modern fractional banking is the idea of required reserves. And an important skill is calculating the change in the amount of required reserves a financial institution needs to hold. The video reviewed some key terms associated with fractional banking, including fractional banking, deposits, withdrawals, reserve ratio, and required reserves. The video also introduced the formula for calculating the change in required reserves. Required reserves equal deposits times the reserve ratio. The video provided a strategy for finding the required reserves, given a deposit and the reserve ratio. Finally, the video worked on a problem statement using the strategy. If you want to try a practice problem independently, there is a link in the description below. If you have any questions, comments, or suggestions, please put them in the comments section below. Until the next homework help video, best wishes on your economic studies.